is thanks for joining DataCon 2023. Welcome to join our business analytics track. My name is Courtney Fowler, and this is my co-host, Bayme. Please silence your phones and Frank flash prior to recording during the session. Everything's being recorded, so we'll be able to take care of that for you and post it on the internet later on. Today we have the guest, Bayme, and he'll talk about talk track investment acquisition and current economy. Ari is a veteran technology, iBaker, and corporate development executive, domestic cross-border M&A experience. And I hope he's going to rouse you guys this afternoon after lunch. Please try your best.
Coming out this Saturday, DataCon LA is just a great event for the community, and just being even attending is a great privilege to be part of this. Thank you. So the reason why I called it the current economy, the irony is that to me, it's almost like we've gone back about a decade, maybe even 2 decades, where what was once standard in the industry is now completely up for grabs. But what I also really want to say is that, you know, working with professionals in the data analytics industry and then going through either a private equity investment scenario or potentially an M&A process, it brings out this sort of inherent tension. Because you're data analytics professionals. You expect strong metrics that are accurate, reflective of the scenario, and then you come to this process and it's nothing at all like data analytics. It's completely subjective. There isn't, in fact, a lot of data. People get seduced by just 1 or 2 key points and forget about everything else. Number 2 is that, you know, we tend to think of particularly investment professionals, private equity, venture, having very strong theses, being very focused. We reduce the fact that to some extent they're just following each other. There are just sort of new trends. You lost my presentation.
I apologize about that.
So yeah, I would say that, you know, the way you would expect a tech conference to have better AV is the way you would expect buyers and certainly sellers to have better analytics available to them. In fact, they don't. Every month or so, I get called up by companies like Capital IQ, PitchBook, and they're like, okay, what have you sold and what are the multiples? That's how they get their data. If I feel like telling them I do, if a client has sworn me to secrecy, I don't. It's really, there's not a lot of it out there. The second thing is, you know, we've been talking about change in focus, change in attitudes. SaaS is a terrific thing, but it's to the detriment of any company that is basically selling a product on a transactional basis. I can't tell you how many great companies I've worked with approach private equity buyers, and it's like a switch has just been hit internally. It says, you know what? I'm just not buying it. We only want to see recurring revenue. This is going to be a theme that's going to come across, which is that buyers and investors are just looking to reduce their risk and focusing on companies with predictable revenue streams as opposed to transactional is one of the ways they mitigate that risk. Everyone is talking about AI. I almost feel like it's besides the point. I will say this. While on one hand, I definitely feel like compared to so many other technologies, this one has legs, this one is going nowhere. In fact, it's been around a long time. Some companies will benefit from this, but if you think just sort of putting .ai at the end of your URL will guarantee a sale, or a boost in valuation, probably not. The other thing to note is that corporate momentum, also inertia. We may have gotten some traction with smaller Soho-sized businesses, and you'll model out that, oh, we can work with a couple of large companies, it'll be terrific, and that's our growth strategy. We tend to miss the fact that larger organizations are incredibly resistant to change. It's just something you need to be prepared for. But I use the phrase momentum because the flip side is when companies decide they do want to change, nothing can stop them. And then the last thing, and probably the most important thing to get out of this, if you can just get one thing, is to avoid headline valuations. And you may know of a friend who sold their company for 20 times sales or 20 times revenue, and you're like, that applies to me as well. Don't ever fall for that trap. We'll just leave it at that. Why don't we quickly jump in with an example before we get into the state of the economy? Because this is something that I see constantly on the M&A side, and to some extent on the investment side. You have a company, it's been around for 10 years, sort of a stealth sort of startup mode, nice revenue, call it 45 to 50, 150 clients, nice margins, 80% of the revenue is transactional, 20% is recurring. In this case, it was a location analytics company. You get an offer from a private equity firm, what we call a standard offer. We're going to give you $43 million. We're going to value you at 138 post money. These are the multiples. We're going to acquire about 31% of your company. We also would like to see 10% of your equity allocated towards an employee option pool. I call this a standard offer, and this is known in the industry as a standard offer, because frankly, that was, you'll see the terms that make it standard. The client says, I don't know. You know, my buddy sold this company, seemed like for a lot more with a lot less dilution. Fine, we bring in another offer. We'll call that the structured offer. Investing the same amount, clearly they value the company much higher, larger multiples, much less dilution. Client's like, why aren't we jumping on this offer? This is why. The standard offer came with what became known as the 1x liquidation preference. Frankly, that didn't necessarily become standard in the industry until about 2009, 2010, when power started going towards founders. Previously, when I first started in this industry, there were 3 and 4x liquidation preferences. Firm number 2, what we called a structured view, came into play. And they said, yeah, of course we're value higher, less dilution, but we need a 2.5x liquidation preference, and we're also going to have a 12% PIK, or paid in kind, which is a form of interest on the deal. It's paid out at the end, and it's paid in equity. You're wondering what's really the difference? This is the graph of the distribution. Founder would be in the common stock pool. What it really demonstrates is that unless you're really hitting out of the park, the 16x EBITDA valuation, anything less than that, you're getting a lot less cash. There's nothing inherently wrong with this. It's a question of balancing risks and rewards. But you, as potential founders, need to be aware of this conundrum. And there's no data that could ever tell you whether choosing one path or another path is really the right way to go, other than sage advice from your advisor and your own gut. In this case, ultimately, they chose the structured deal, and it actually worked out really well for them. Ended up selling in a very short period of time at a very high multiple. They were glad they chose it. But they also knew they were a high growth company, everyone would be all over them. Which one would I choose for people in this room? Really, it's going to depend upon you. The key takeaway is this: don't just look at the multiples and the dilution, which everyone else does. It's only maybe 1/10 of the story. Okay, so now we'll back up a little bit. We've kind of thrown you in. Okay, what exactly is going on in the market? The truth is, it is a lousy market. Even with all the excitement about AI, we're entering a stage, back when I maybe first started working in the internet, where investors have taken control. And a lot of the things that we came to expect as founders are gone. And this is the reason why. This is the broader software market. It'd be very hard to pull out just a group of analytics companies. There'd be a lot of confirmation bias in it. What you can see, though, is that the earnings multiple on the left is almost back to where it was on its 5-year trailing. But on the sales multiple, it's nowhere near where it's been on its trailing average. Just starting to boost back up, but not quite there yet. It's basically telling us what you would expect it to tell you, that the market is really no longer giving high valuations to companies that haven't proven their model. If it doesn't translate to a bottom line, they've kind of lost a lot of interest. So if you're planning a startup, if you have a startup, you really need to be thinking, what is my road to profitability? This is what the public markets are saying. It's going to translate into the private markets. And here we see the activity at each different investment stage, C, A, B, C, and D. As we can see in the gold, the number of completed deals is way down. And the overall pre-money valuations, in some cases are down. Sorry, in some cases, in one key case is up. In most cases, those are also down. The takeaway is probably, I feel like we've hit the bottom on these valuations, but the market is really basically telling you, especially from this stage on the left, for high potential seed startups, such as AI, which is a very attractive vertical, the valuations are still there. Along the spectrum, they're basically admitting that we overvalue companies at every previous stage, and there will be a continued reckoning. Shorthanded version, if you want the cliff note, you had a friend that raised money in 2020. Don't ask him what his valuation metrics are because they're just not relevant. Further proof as to what's going on here, that I feel like we have hit a bottom and that there still is a market for quality. We're looking at the divergence on whether there was a premium or whether there was a discount over previous rounds. Once upon a time, this whole having a down round in which valuation from one round to the next actually went down used to be perceived as kiss of death. We're in a different economy right now, things change very quickly. It is acceptable just to stay alive to accept a lower valuation. And we're seeing it extensive. That being said, the premia that we are seeing on is finally coming back up to a level we haven't seen, meaning we're getting back to where we might have been pre-2021. The other factor that really tells me this is the bid-ask spread. This is secondary transactions for shares in privately held companies. So for a lot of larger companies, you can buy and sell shares constantly. It's not that easy, especially if you're not an accredited investor, to see this data. And of course, this goes to the underlying thesis. There isn't a lot of data on these deals available, but this we are able to scrape. And as you can see, it's finally returning to its values. What it is saying is that third-party investors that may have missed the ability to invest in a company, they just weren't invited to that round, have finally come back to those rounds and are able to buy shares from employees at a rate which is more or less what employees will accept. This is a positive development. You're wondering what's going on here. It's a lot of different stages and what we're pulling out of this. So A, it's just further proof that the discounts to prior rounds are continuing. Why is this happening? I wish I could tell you there was a more scientific reason, but the reality was in 2021, 2020, and in 2022, there was a lot of outside capital going into the venture markets. So not just venture funds themselves, but traditional institutional investors starting their own funds, corporate VCs. There was too much money chasing a lot of deals. The returns they're getting, having these down rounds, has chased a lot of this money out. So while the valuations are down in other rounds, we're going to see flat valuations moving forward until there's a major recovery in the market, which is not expected anytime soon. That being said, you can see that at the seed round is sort of one of the highest. upsides, which just goes to show you good companies are still attracting strong valuations. I really feel like this really just tells it all. You're going to have less bargaining power as a founder. Those with the money will just have more bargaining power. That being said, the last fact that the pre-money valuations are still going up. This is the chart on the right, especially at seed level, tells you there is a massive demand for strong companies. Generative AI. There's so much we can talk about AI. It is generative AI, what makes it so special. This is one of those interesting data points where there isn't actually a lot of data, so you have to interpret the graph from the view of experience. So yes, deal count is going up. Pre-money valuations definitely going up. The size of the deals are going up. However, I can tell you, watching these deals closely, and it's not reflected, a large portion of this actually is a few key deals, particularly the OpenAI deal, things of that nature. It's really grabbing it. As a data professional, you're like, wait, I see these averages. This is not really the metric that's out there. Deals are getting tough to get done, and we're seeing a lot more terms that are coming in. I don't want you to think that there is sort of a conflict between investors, particularly at the VC or private equity level, or even corporate buyers and founders. What needs to be understood is what are the levers that are driving things both ways. In this economy, essentially what investors are saying is, give us a greater guarantee. Give us something that if this does well, we'll all do well together, but take some of the risk off of us if this doesn't do that well. And in particular, what if it only does okay? That's what we're seeing. There are so many terms that we could write into a term sheet that capture that. The easiest, we would be here for hours. But the key ones that come up. How many warrants are you getting? Will there be set restrictions on secondary financing? What's the conversion price? Anti-dilution clauses, a liquidation preference, and a PIK index. We go through all of these, but I feel like it's probably better if we wait till the end and then ask specific questions on these, because for all of these, there's like 20 more. The other key point I want to get across is that we sort of use these terms standard versus structured. This comes in particular when you get to your LOI or IOI stage, which is they'll say, oh, standard governance terms. These have changed completely. What do I mean by that? If we went back to the first example, one of the issues that the client had with the standard deal is that they took more equity than they realized. It was 31% versus 24%. There were also 5 founders, each of whom had an interesting portion of equity. And then, as opposed to what they called standard corporate governance issues, these came out as approvals on hiring and firing. It said that they would get to approve the budget. It said that they would get to decide on the sale of any asset at any price. And basically what they were saying is, even though we're only getting, we're a minority investor, we're getting 30% of your company, they effectively controlled the company. Moreover, given that the number of founders was 5, if there would have been a lack of cohesion among any of the investors, any of the founders, they immediately would have been pushed out. This level of dilution in this economy is very common. It's something to be aware of. You don't want to start a company and then find yourself pushed out. If you don't perform, eventually that will happen. You want to delay that as long as possible by maintaining as much control. What's going on the M&A side from public companies? It's like everything else, a lot slower, lower valuations. It's just going to be constant. It's the same theme, but whether you invest, don't invest, track public stocks or not, you need to track these indexes just for the sake of knowing what's going on in public markets, because it will boomerang right back to you. Some of you are saying, okay, but generative AI is the hottest thing. It doesn't apply to us. I want to point out that this is across almost all verticals. And the ones that were actually escaping this were things like healthcare tech, very small outliers, but almost every other vertical impacted by this. And of course, this is most particular, the IPO window is more or less been closed for a while. And in terms of exits, you want to be thinking about the size of your company. And of course, the pullback happens the most in small and mid-sized companies. Larger companies, just by dint of greater stability, have been lasting longer, get a higher valuation. The last thing to take a look at is, while we all tend to think of startups garnering these incredibly high valuations, all the way on the right, the median enterprise value to EBITDA ratio is 4. Think all the way back to that first example of that term sheet. They're like, oh, founders were sure they would be 20. Probably not quite as strong at times. 9 or 10 is a much more realistic figure. So what is still driving all sorts of deals and why we think data analytics is going to remain a robust space for consolidation? Just the constant change and the fact that finally we're seeing just such widespread adoption of analytics across all of the areas of the market is driving this. So for example, all the way on the right, once you start using, let's say, AI and a large language model to access all your data and to pull up all the analytics that you need, how do you actually ensure you don't have a garbage in, garbage out problem? More to the point, how do you reconcile these things across multiple countries, multiple areas, and how do you put in the governance and security you need? Will be constant focus on startups that can solve these problems endlessly. The transition from a channel-based product to a sort of a freemium model, or usage on demand, the number of industries around that are incredible. What we don't realize is, okay, how do you scale up? It used to be you had to start with a massive data infrastructure. How did you set up the caching? It was all done in advance. It required a massive amount of capital. This isn't just cloud-based tools. It's all the tools around it working in a cloud environment. Real-time data. The fact is that I would say within 5 years, if you don't have access to real-time data within a millisecond, you won't be a functioning company. It's not just for fraud. It's not just for supply chain. Meaning right now, oh, everyone wants to know, we have a brick and mortar store, we have an online operation. How do we allocate inventory? What we're seeing in the future is actually instant change in your supply chain on each individual sale. The ability to pull up these quotes constantly in real time is a very data intensive product and will continue to drive M&A around that area. Honestly, the first two are just the most obvious. Switching to a data mesh and just taking all your data off premises. I was talking about this last night with a friend of mine. He was like, isn't that obvious? But then we were at a session just this morning and in the keynote pointed out the incredibly high percentage of companies that still keep most of their data on premises. It's just going to continue to move off. Honestly, as data professionals, I would say you know better than your investment advisors what's driving the transactions. I think where advisors give you help is what's impacting these transactions and what's slowing them down. And frankly, what we've seen in our industry, the number one is lack of regulation, which is ironic because this is a tech conference. Most people hate government regulation. Where does this come into play? Things about data collection. Do you hash it? Do you not hash it? Can you even collect it? Right now, numerous companies track data from location. Most credit card fraud depends on where you are and where you've been. And at the same time, Elizabeth Warren has a bill in front of Congress she's proposing that would not allow you to collect any data from apps that track your location. The reason why we know this will drive M&A is if you go back to the beginning of the internet, spam was a huge problem. And the problem is companies were getting tried in the court of public opinion. We see this now. We'll see an incident where there's a company that does location tracking, and all of a sudden, one bad actor uses it to target people that have gone to abortion clinics, which is horrible. It was a one instance, and immediately the whole industry is impacted. The moment the government passes a federal law on data collection, how it can be used, will exponentially increase the number of deals that we get done. We're already seeing this in generational AI. At a certain point in time, there's this inherent instability, which is, how are we going to resolve the copyright issue? There are a lot of companies getting funded. For all we know, at some point in the next 2 years, there'll be a breakthrough lawsuit or a breakthrough settlement. Companies will run away from this space. The sooner there is a government regulation, it creates a safe framework for valuation. The sooner there's a safe framework for valuation and investment, that's when deals start happening. Recurring versus transactional. I mean, it drives me crazy when I have clients who have such strong businesses. And frankly, sometimes you have to ask yourself, I have clients that have 95+% year-over-year client retention. And not just on a yearly basis. Retention 34 out of the trailing 36 months. If only they shifted their model towards a SaaS model in which they gave away the services in exchange for subscribing to the product, their valuation, what would be the difference? Ballpark, about 80% higher. This is just direct effect of being in a guarded market. If you don't have a predictable revenue stream, people are not yet interested. Vendor compression and 3 and 4 are almost identical. The problem that we're having is that buyers don't want to have multiple vendors. It's both a positive and negative in the sense that, think about your marketing stack. How many companies would you like to have in it? You have someone that does your CDP, you have someone that does your analytics, you have someone that does your identity graph, you have someone that stores your data offsite, uses it, you have multiple. You have someone that protects your data. Clients are saying it's just too many. We want one. So on one hand, it's driving acquisitions of smaller companies into a unified stack. On the flip side, though, it's essentially putting a cap on growth of certain companies, which, while deals get done at a lower rate. Defining metrics and redundant product suites. There are, in a lot of ways, there's still a shakeout to come in so many areas of the analytics industry. Marketing, for example. There are so many different companies that produce identity graphs. We couldn't even begin to count them. And then, of course, there's a million other people that say these graphs are useless because at some point they rely on cookies. What's the point of these cookies? Because A, they're not accurate, and B, they're going away. If other people say, well, what's the point of all these identity graphs if they don't track location? That's the one source of truth. Then the last people say, yeah, well, you can't track location. It's illegal. Where am I going? How you define what a user is, how you truly get to the identity. People are confused about this, and as long as there's confusion, what ended up happening as a result of that is that a lot of companies have overlapping product suites. So you have an identity graph and you have a data management product. Okay, but they only want your identity graph. They don't want your data management product. That just knocked 30% off your valuation. Overlap in that is that the vertical focused issues, which is that, particularly as we go into analytics, controlling and managing your own data is incredibly important. So for example, you might have an AI that uses captive LLMs to drive efficiencies. Sounds like a great thing. You've done a terrific job in corporate purchasing. You say, terrific, we're going to go to the healthcare system. There's an incredible amount of waste. Until you find out that actually the healthcare industry is focused on billing more, not less. You have an AI tool that tells you, who a fraudulent advertiser is. Fraudulent bot traffic is. You can reduce your traffic by 60%. We'll take away all the fraud. But you're an ad agency. That just means you've lost 60% of your revenue. It's crucial to remember that it doesn't, what works in one industry does not translate into another. And as you try and sort of model out your valuations without specific industry and vertical knowledge. And then lastly, all of these anxieties can be captured as in AI anxiety. What does that mean? Is that there's activity at the venture level. There's activity to some extent at the private equity level. There's been minimal M&A activity because frankly, larger companies are scared of it and they'd rather sit and wait. No one wants to do a deal, have it blow up on them because of a regulatory issue, and then they get fired. Let's open up to you guys. Let's play with some scenarios. 10-year-old company, 45 million, same as before. Would you be in a rush to sell? Would you prefer to go to a strategic company? Would you rather sell to private equity? Or should you just alter your business model? Who here prefers A over B? Who prefers C over A? The truth is, the answer is to where you stand. There's actually nothing inherently wrong with any of these issues. Ultimately, we told the client C, which is, if you're profitable, and you have strong net margins, never be in a rush to sell. The opportunities will present themselves to you. There's no reason to take the door. This is probably more relevant of what we see with companies working with MLMs. They've been around for 3 years. It's typically 1 or 2 founders, maybe 1 founder, 2 salespeople. The entire dev team is offshore. They have a handful of enterprise level clients. Out of nowhere, they'll get an LOI, non-binding from, maybe it comes from a large client, maybe it's an offshore contract firm. Why do we say that? Because what ends up happening is almost always we see this, it's the other contractors at their clients tell their companies, you should buy this company, it's going to put us out of business. Take it for what it's worth. Should you sign the LOI? Should you sell your largest client? Should you raise money? Should you start an M&A process? There's no right answer. All I can say is 1, don't ever be in a rush to sign an LOI. It's going to end conversations with anybody else. It's the initial sign of interest. If you've got 1, either it's nonsense, they're trying to fill you out. If it's a real offer, the reality is there's 3 or 4 other offers waiting. Should you sell to your largest client? I would say it really depends on where you're at in your revenue stage. For a company of this size, and frankly, anyone under 20 million, where they're already seeing a dispersion among clients, it's the wrong way to go. It's the wrong way to go for 2 reasons. 1, you're never going to get the highest value. But number 2, as a founder, an M&A investment, it's not an exit. It's not like you want to leave, it's off to the next thing. It's the invitation to go up to another higher level, to essentially run your startup within a larger organization, if you're up for that challenge. And just to sell to a single client is more akin to just getting a job. That being said, if you had just 1 or 2 large clients, you're at a level of 10 or 15 and didn't see a cap, it's an attractive offer. Should they raise money or should they sell? I have to tell you, in this economy, it's the wrong time to sell. For a company like this, where you're just beginning to break even, hold off. Because as we've shown in the funding life cycle, if you're a strong company, and in this case, 3-year-old is close to a startup. They do have traction, they do have revenue. This is a company where investors will not be looking at, okay, you're just break even. They'll be saying, what can we do to scale you up to 50 clients and be the leader within your vertical? I know you're from ventures. You might say otherwise, but we think this is a great game. Selling now, it's a little too early.
I agree with you, by the way. I agree with Grace.
These are very judgment calls, and that's why I wanted to get through this very quickly, and then we'll quickly open up to questions because every scenario is different. But honestly, this is the one that I'm hearing endlessly, and it's not really coming in through our typical business channels. It's actually coming in from like, I don't know, children of like friends of my mother or something like that. People very successful left say, oh, let's jump out, start it, and just by dint of previous experience, are able to get one or two startup tests. And then randomly they're talking to their boss, like, oh, we have to have you. Here's this crazy. I wouldn't dismiss the offer out of hand, but I got to tell you, yeah, crazy offers are really just that. And as we've gone over 100 times, it's the headline. That $20 million offer was probably in a liquid stock, and only if everything aligned would it really come true. So listen to it, but don't jump at it. Safe round. IPCs don't actually like these, and the reason why it's applicable to this situation is that essentially it allows you to defer the valuation. We're in a place right now where, granted, appetites for these are down. But essentially, in a safe round, you describe your business, you go out to accredited investors. And the valuation is not described until you actually raise an institutional round, essentially a Series A, and then it's a discount of that. Why do I bring it up? It's because in a confused time. So while in every other vertical, there's a lot of down rounds, lower valuations, not a lot of leverage. Where you do have leverage, hold off on that valuation. Will pay off in spades. I think that's it. Don't worry about that. Just if you ever want to get in touch with me, feel free to do so at any time. Screen. Let's just open it up to questions.
So right now we're going to the questions. So if anyone has a question, we'll kind of walk around with the microphone and.
I specifically wanted to know about AI and my question is, I work in a company that predominantly works for private equity firms, and we were working on automating valuation. What I realized is that we were not going to work with implementing. By that time, we closed. So, do you really use AI methods, or do you work on conventional methods for valuation? That's what I have seen happening through my experience.
Well, I think that's ultimately the point, which is that people get very distracted by just one or two metrics. They're missing all the metrics in the middle. So it's potentially a guideline to where the industry is going, but quite frankly, for the 2 or 3 metrics that people can track, in reality, there's like 10 more that are way more important. Concentration of revenue, the verticals that you're in, the size of your market. So no, I don't think you could really use AI until we get to a point where there are much larger models. The second point is that a lot of that data nobody wants released. So, I mean, for all the data that we've shown, there are hundreds of deals, probably an equal amount where it's never reported. Current regulations for public companies, it's less than 5% of your trailing revenue. You don't have to report the valuation. They don't. Private equity firms don't need to, tell even their LPs how much, what the metrics were on their valuations.
Shouldn't it be public knowledge, considering they have to sell it out, they have to sell their share someday?
Whether it should be or whether it is are two different things, right? Right now, no. Think about it also. You might have invested at actually a very attractive valuation. Why would you actually want that to be told to the industry? Because inevitably, the larger rounds. But you do bring up a good point, which is a lot of people think that VCs actually want to invest at lower valuations. Not really true in some instances, and I'll tell you why. And those sounds very counterintuitive. You're a VC, you raise money, you put it in a fund. The fund pays you a management fee. You invest in a certain number of deals, you have success. You go out and you raise more money. If the size of the check you write for each deal goes up, you raise more money, therefore get a higher management fee, and you crowd out smaller, undercapitalized competitors from getting into your space. Something to think about.
Another question? More questions? Here we go.
So in your presentation, you were talking about how now is not really a great time to sell business. It would be a good time to sell it. Not as much funding, slowing down, generally speaking, they change so that funding increase.
Well, I'll tell you this. It's a good time to sell, as the trends have shown, is that as an overall trend, valuations are down, both at venture, public markets, and private markets. But there was always that small area, for example, on the seed round valuations going up too much higher. As we kept pointing out, attractive companies are still drawing at these valuations. There was recently, ad tech has been a vertical which has been dead. Literally, there have been almost 0 acquisitions in that space in the first half of 2023. And then recently, a company called SideBids, which claims to use AI in a number of different techniques, actually did get sold. I wasn't focused on the fact that, immediately there'll be a lot of deals in ad tech. What I noticed was in the second paragraph of the press release, they then sketched out exactly how much revenue they expected to gain off this deal, what the boost in performance was, what the boost in margin was. So where you have a company that can bring, if you have just an AI company, as people have pointed out, you build something because it's cool, people use it because it's free, remains to be seen. But if you build something and you've taken it to your clients and you've insisted, and this is especially important in this economy, that any test you run on efficiency or metrics be completely transparent. So you know what the performance was before the implementation, what it is after. Once you've done that, you've won the battle. Because now it's all analytics professionals know, it's empirical, it's obvious for everyone to see. That makes the negotiation for me, for a buyer, that much easier. Where I've had clients that can do that, I've asked for the roof and we've gotten it. Just the way it goes.
You don't holding on to any RSUs out there? Just me. So bad time to sell, bad time to go public, right? I have a question essentially, right? So with the IPO market being kind of dried up right now, what's the outlook on that? Is it just going to be the same because the market has dried up on credit, that there's uncertainty still with how inflation has been? Is there any other indicator that might kind of lead to better outlook on that?
Interest rates, biggest predictor. I mean, 7%, in the scheme of longer history for people that are older than college students or graduate students, it's actually not that high. But in recent memory, it's the highest it's been in a very long time. The moment these things get down to about 4%, consumer sentiment opens up, we'll see a big change. Until then, not really. If, for example, and that being said, it's not that the IPO market is closed, there's just been a massive flight to quality. So the moment the first, generative AI company that is free of any legal restrictions and can actually demonstrate exactly how much it saves to its clients, it'll go IPO in a heartbeat. The demand for that will be through the roof. Without that, going public as a SPAC or just pure speculation, not going to happen for a while. It's SPAC, nice.
Going back to your part of the presentation, what's your sense of the government's of nailing down these things besides like what's your sense of this?
So I have a contrary. I think that the industry needs and actually wants regulation around data collection, data policy, data usage, and the other underlying issue of copyright and AI. And without those regulations, actually, we'll see stunted growth. I don't think it's a question of down. On the copyright issue, someone brought up the issue, particularly around the strike of, it maybe feels a bit like we're close to Napster coming into the space, and it was a consumer choice. Maybe on the AI issue, But on the analytics issue, the lack of real regulation in this country over privacy and data collection is absolutely hurting the industry.
Do you think it's going to happen soon, though? Do you think the governments are going to?
It's not a question of caving. I think the industry wants it, not the other way around. Of course, the industry doesn't want it on Elizabeth Warren terms. They want it on a very sort of like a canned spam act where you check off 1 or 2 boxes and this canned spam stops spam. But no, it's just made it legal for people to send it. That's what the industry is
I remember when I watched the first conferences, and a lot of them, they didn't even know at the time how they were going to make money. And I guess that's sort of a common sentiment in an industry like AI, where you have to develop a lot in order to get to a point where you're actually going to be profitable in a sense. So are you saying that those sort of ventures are probably not going to happen in the foreseeable future?
not probably not, but are they down? Yes. Are they way down? Yes. But if you're a very strong product team that's had success in the past before, because now we're talking at a venture level, where what are the metrics of the founders? If you're a strong founding team, a very strong technical team, developing IP and strong usage, even though the economic model is developed, at that stage you will see, albeit with a flight to quality, continued investment. And that was the chart that showed that although in most rounds of VC, we're seeing a down round, at the seed level, we're still actually seeing an increased valuation for certain companies, even though the number of seed rounds is actually down. Does that answer your question? So strong valuations, but for fewer companies. What makes, by the way, a strong company? Completely different.
I guess has that changed? Used to be strong value financial statement. Now
it depends on the stage you're at. It's still founders, strong founder teams, strong technical teams are still the requirement for VC. Private equity level, it's profitability and your ability to forecast your profitability out over a longer term horizon. So if you were profitable and you could forecast it, let's say out 1 year with some certainty, 2 years with 50% certainty, that was enough. That's not acceptable anymore. It has to be a SaaS model at this point with predictability going out to sort of 5 years. At the M&A level or at the IPO level, then you have to just be a defining category killer. So in some ways, it's the same all the way across. Predictability, strong track record, and a flight to quality. And it will remain like that as long as we see interest rates at this current level. And frankly, maybe this is better for the industry. See.
Any other questions? 3 minutes left. We can actually about a minute left. I guess with that, guys, again, thank you guys for coming to this talk track with Ari and Bayme. It's been a great time enjoying this, right? If you guys are staying for this next talk, please stay around for our news. But I want to join us in thanking Ari for his time. And 23. There's like a